Hi guys, the purpose of this video is to show those that are new to Binance how to enter trades on Binance. So let me quickly turn on my laptop and then go to a cryptocurrency pair right now so I can make a signal and show you how it's going to be done. Okay, let's open Binance app, and then I've already transferred a little bit of funds to the Binance, and in the process I caught a trade on Binance, yes, which is this. Okay, so this is how your Binance Interface app looks like. And if you want to make transfer to your futures, because we deal with futures, you come here, click on futures, you can see futures. But before you get your funds to the futures, you just come to your sports wallet, you click on transfer, and then you click from spot to futures USD, that's all. And then you input, if it is BTC you click BTC, if it is USDT then, but it's definitely USDT because you've clicked on USD futures, so you transfer from your spot to wallet using USDT. You click on this BTC icon here, so it will change it, you change it to USDT and then enter the amount you want to transfer and then confirm transfer. Okay, I think that's all. And then once you've transferred, you see the money in your futures wallet ASAP immediately. You see the money in futures wallet in this place. So this is where you check your money, your future wallet, everything. But for trading futures, this is where you come. Okay, now the trading is, this is where the work is. Now to select any pair you want to trade, maybe I send a signal. Let me quickly run a signal right now. So let's say I send a signal on uh BTC USDT. No, I don't even send signal on BTC USDT. So let's just quickly check BAT. So let's just say I sent a signal on BAT USDT and I say okay, yes, and I say sell limits on BAT USDT. So you just come here. Sorry about that. You come here, you click on that sand, you search for BAT USD. You can add it if you want, then you click on it. If it is a sell limit, you come to sell. If it is a buy limit, you come to buy. But once I'm saying sell, you click on sell. So if it is a limit order, you look for limit here, which is there already. But if I say sell BAT now, it means you use market price. You understand what I'm talking about? And then your TP or SL, this is where it's going to be. Now let's, for example, most of the time I always use pending orders, so let's just do it limit orders here. But if I say sell BAT now, you just know, you come to the market, you click on sell BAT now, and then I'll give you the stop loss. Definitely I'm going to give you stop loss. Maybe it's 1.221. So I'm generating the figures because my laptop is in front of me. That's how I'm generating figures. So you click on sell short. Okay, but right now I don't want to sell at market price. I want to give you how signal is going to be. So if I say sell limits on BAT USDT, sell limit at 1.1152 1 point. Okay, so you come here, this is where you put the limit. You can see below the limit, that's where you put the figure, the the price rather, not the figure, the price. So if I say sell limit at 1.1152, you see it's already set. And then your stop loss, you can see once you click on stop loss stroke TP, it will come up. So you click on stop loss, and I'll definitely give you stop loss. So 1.1221. So we are done. We are done for that. That's how to set your pending order. Then you click on sell short. But by the way, you have to know how much you are risking. Because we deal with risk here. So if you want to risk, if you want to know how much you are risking, there's this little line here. You can see this little line I'm drawing. Yeah, that little line. You can see that as I'm drawing it, my USDT is moving below me here. Where can I get my drawing tools? Okay, yes. So you can see here, just keep checking that point. You see something like one, it will be increasing. So let's go. You can see it's already increasing to 2. So if you want to use $5, you just you just swipe it. And if you want to use $1, then you just swipe it around. You can see what I'm talking about. So you click on sell shorts, that's all. Your symbol is there. This is the price you want to sell, amounts, Margin required. Margin is the amount you are risking. The mark price, estimated liquidity price. So this is the price it will reach where uh all your money will get lost. You understand what I'm talking about? That's the whole $1 you're risking is going to get lost. That's the estimation liquidated price, and the mark difference is 14 percentage. Stop loss is this. Then you confirm sell. Once you confirm the sell, since it's a pending order, you can see it is here. Open orders 3. If you want to cancel, if I say delete the order, maybe you want to cancel, just come here, click on cancel. Very beautiful. And then if your trade is running something like this, you see something like this. So this is the unrealized profits. You can see here. This is the return on investment. You can see still 10%. It's still very low. This is the amount I risked, 1.93. This is just for sake of this video. I just did this because of the sake of this video. Now if you want to close position, you just come here to close. You click on close. So this is 100%, 75%, 50%, and 25%. It means if you want to close half, you just go to 50% and confirm close. If you want to close the whole 100% of the trade, you do that. Very simple. Now if you want to lock profits, you just come here, stop loss and profits. And once I say lock profit at whatever, you just come here, stop loss 0 points, whatever price, and then your profit will be locked at that point. You can always check that on your chart by yourself, because I don't think I always send lock profit on crypto. Now the remaining part I want to talk about is this cross and then isolated margin, and also this 50x that we can see here. Now this is where the complication comes in, but to me it's not really hard. Let's first deal with leverage. Now this leverage means if a coin moves 1% and then you put it on leverage 50x, it means on every 1% that the coin moves on maybe TradingView or on, whenever the coin moves, if the coin moves 1%, then it means your profit is going to be 50% or your loss is going to be 50%. You understand what I'm saying? So if you also put it in 1x, it means if once the coin moves 1%, your profit is going to be 1% or your loss is going to be 1%. Now if you put it in 20%, it means once the coin moves 1%, your coin is going to move in profit. That same coin is going to move in profit of 20% when it is moving 1%. So it means if the coin has now actually moved 20%, then your coin is going to move times 20. So that's 20 times 20, that's 400 exactly. So this is the way leverage works, depend on how fast the coin moves. So if the coin moves 5% and you put it on times 10, it means on your profits is going to be times 50, right? Because you are using times 10 leverage, because the coin moved 5%. You understand what I'm saying? So this one is just percentage you want, whichever percentage you want your profits to move whenever the coin moves a particular type of amount of percentage. Okay, this one is still running, and now it is moving. You can see I'm using cross 50 here, and then it is moving time plus 11%. It means the coin is moving something around 0 point something percentage. It has now given me, the coin has now moved 1%. So once the coin moves 1%, my profit is going to be plus 50x, sorry, plus 50% immediately. This place immediately, but the coin has not really moved up to 1%. That's why we still have 10 here. But once the coin moves 1%, I'm going to have 50 percentage of profit running. If the coin moves 2%, then my profit here is going to be 100% immediately. You understand what I'm saying? So if the coin moves 3%, my profit here, this plus 9 here plus 8 that you can see, is going to be 150 immediately. So it means 150% of $1, it will be this unrealized profit here. So 7%, 9% of $1 is 0.17. So everything works hand in hand. You understand what I'm talking about? So that's just it. Because I'm in times 15 now, if the coin moves just 1%, my profit is going to be 50% immediately at this place here. That's because I'm using times 15. Now times 50 is actually dangerous if you are using funds like $100, because you can see now, if you are using $100 margin at this point, or your risk is $100 and it is 11 percentage already, you should know how much you should know how much you are gaining already. You understand what I'm talking about? But because this one is $1, that's why it's advisable to use a bigger leverage. But if you know you are a very very high risk taker, then if you are risking, your leverage should be 20 to 25. You understand what I'm saying? Your leverage should be 20 to 25, so that the percentage will not be too much whenever you are in loss. Because we have to know how to manage our risk here. So if you know you want to be risking, let's say from here, let's say you want to be risking $5 and above, $10 and above, then you should know that you should be using leverage of 20 or 25 or 30 or even 10. And you should know that if you are risking let's say $100 and above, $150 and above, then your cross should not pass maybe 10x. You understand what I'm talking about? So that whenever you are going to be a very deep drawdown, you understand what I'm saying? Okay. Now, this is cross, we have cross, this is isolated. I always use cross because since we're using stop loss and you know. Now, let me first explain isolated. Isolated means if you are risking $1, your loss cannot exceed $1. It's just like forex. When you are risking particular amount of on a particular lot size, and your loss cannot pass $5 if you are using 0.1 and 5 pips SL or something like that. And same thing goes here. So isolated, if you are using isolated margin, it means if you are risking $2, your loss cannot pass $2. If you are risking $5, your loss cannot pass $5. So it means if I'm risking $5 on a trade and the market has not hit my stop loss, it means the trade will close automatically because it has already reached $5 risk. So that's the only disadvantage, because the only disadvantage is if you are risking a particular amount and then the particular amount has been gotten to already. Let's say you are risking $1 and then your funds have already gotten to -1 without hitting your stop loss. It is going to close automatically. Why? Because you are using isolated margin. You can see now, this is Binance. It's a little bit different. It's not like forex whereby you just set your pending orders or your lot size. No, in forex we deal with lot size, so there's a little bit of changes. But once you are on cross, it means if you are risking $1, you are definitely actually risking the whole, because it is cross. It means you are risking, if you are risking $50, actually you are risking 50 sorry 50 $50. Yeah, if you are risking $50, it does not actually mean you are risking $50. It means you are risking the whole in your wallet. You understand what I'm talking about? That's I use cross. Now, if you use cross and then you are not using stop loss, it means you are very very stupid, because even if you are risking $1, it does not mean for example, okay, if you come like this and you risk maybe $3 on cross or $2, it does not mean you are risking $2. It means you're actually risking the dollars in these wallets by using cross margin. It means if the loss reach $2 and then there's still money in your wallet, it will continue reducing or taking out the money from your wallet till you hit your stop loss. You understand what I'm saying? Why I always use cross margin is because once you are using isolated and then the market gets to, let's say you are risking $1, and once it gets to $1 risk that you are trying to risk without hitting your stop loss, it's going to automatically close. And I don't want my trades to automatically close before hitting my stop loss. So, but once you are using cross and then you are using stop loss, it means it's a very, very good thing to do, using cross and then using stop loss. So even if the only disadvantage is that even if you are risking $2 and then maybe your stop loss has already, maybe your trade has already gotten to -$2.5, but it will start taking out from this $7 that we have here. Why? Because you are using cross margin. But once it hits the stop loss, let's say the stop loss is at $3, then it's going to definitely close at what? $3 automatically, because you are using a stop loss. So never trade cross without, that's not what I'm saying. Never trade cross without using stop loss. But if you are trading isolated, then you can, if you want to use stop loss or not, just make sure that you are risking according to your knowledge, according to what according to you, your appetite. I think that will be all for now. And if you have any questions, just let me know. If you have any questions, let me know. I'll be so eager to respond to you. And I think that will be all. So it's the same thing for buy also, if you want to buy or if you want to sell. So that's the sweet thing about futures. If you can buy or if you can sell, you can see now I'm in a sell position on sand, I'm in a sell, not buy, and you can see. So if this, because I'm on times 50x, if this coin should move 1%, this 80% would be 50% immediately. Okay, so I think I've explained enough about the cross. So when you're using cross, make sure you use stop loss, because if you're not using stop loss, all your funds are actually at risk, not only your spends here, all your funds are actually at risk. So, but according to the signals I send, uh according to the signal I send, I don't, if I send a signal on crypto and then you are using cross, don't be scared, because sometimes even if we're on loss of, let's say we're even going to hit our stop loss and then we use 1% risk, and we use 1% risk, so most of the time we only, if we're risking, let's say $1 at this point, or $2 or $5 or any amount of dollars. So most of the time, because our stop loss is always tight, it doesn't always take up to $5. $5. Sometimes the loss might just be -2. Why? Because we are using a very, very tight stop loss. So smart money traders are the ones enjoying most on Binance, because even most of the time when their stop loss hits, it doesn't take funds. It doesn't take out all funds they are risking. Why is this? Why is this happening? Because most of the time, let's say you are risking 1% of your trade, and so it means this trade has moved 0.5% already, because 0.5 times 50 will give us 25. So if it moves 1%, I'll get 50% profit. Okay. Now, what I was trying to talk about, like, okay, let's say you are risking $5 and then you're using a very tight stop loss. Let's say the stop loss is on 0.5%. You understand what I'm saying? And your risk is $1. It means you are risking 0.5 on a 50x leverage. I know it's going to confuse you a little bit, but the mathematics is also it also confused me at first. But when I started taking trades on Binance and I started using stop loss, smart money always use tight stop loss, and it's always very, very beautiful, because you don't always, your loss is not always up to risking whenever you hit your stop loss. So I think that's the beautiful thing about smart money concept. So fear not when I say use cross, because we're using stop loss. The only thing is your leverage. If you are risking low, use a big leverage. If you are risking high, use a small leverage. Yeah. The bigger your risk, the smaller the leverage, and the bigger the leverage, the smaller your risk. So I think at this point I'll say peace, guys. I'm out.